Good morning, everyone. Welcome back to the class Project Feasibility Study and Management. This week is the week number 10. I would like to introduce you to know the concepts of financial statements because the topics of week 11 should be the pro forma financial statement. The pro forma financial statement is to forecast the three main financial statements. You need to forecast the three main financial statements that are first one, income statement, second, balance sheet, and third one is the cash flow statement. Before we start our business, we need to forecast that in the future for the next 3 years or 5 years, whether our business will bring us profit or loss. Should we invest or should not invest in the business? The learning objective of these topics, I mean the topics of the week number 10. The learning objective of these topics are here. For the PowerPoint set of the 10.1, the concepts of the income statement. I expect students understand the financial statement, the purposes of financial statement, and I expect you can describe the components and concepts of an income statement. For the PowerPoint set 10.2, that is the balance sheet, the concept of the balance sheet. For the PowerPoint 10.2, I expect students can explain the concepts and components of balance sheet. For the PowerPoint 10.3, that is the topics of the cash flow statement. I expect students can explain the concepts and components of cash flow statement. And as well, I expect students can apply the interrelations of elements in income statement, balance sheet, and cash flow statement. As a result of the learning objective, I then introduced you the concept of the financial statement, income statements, balance sheet, and cash flow statement. As I mentioned earlier that in the PowerPoint of week 10.1 would be financial statement and income statement. The PowerPoint set of week 10.2 will be balance sheet, and the last PowerPoint of week 10.3 should be cash flow statement and the interrelations of the three financial statements. The first one, I would love to introduce you to have the idea, the financial statement. What are financial statements? The financial statements are formal records of financial activity. For example, an income statement provides summary of financial performance that your business gain profit or get lost during a period. Balance sheet, right? The balance sheet provides the stakeholder. The stakeholder should be include the business owner, investors, creditor, or bank. Balance sheet provides the stakeholder a summary of financial positions of the assets, liabilities, and equity over a specific time. The third one, that should be the cash flow, right? Cash flow statement. The cash flow provides business owner a summary of cash inflows and cash outflow of the three main activities. The three main activities are cash flow from operating. The second one should be the cash flow from investing activity and the cash flow from financing activity. As well, financial statements are prepared in accordance with general accepted accounting principle or standard, such as IFRS or GAAP. On this slide, I would like to introduce you to have the idea, the purpose of financial statements. Firstly, the purpose of the creating financial statement. The financial statement will provide the business owner the useful information for decisions making. The purpose of financial statement are to provide the business owner the useful information about the company performance, about financial health, and about cash flow for decisions making. The financial statement enable the stakeholder like the investor, right, the business owner, the lender, and the management to access the company profitability, solvency, and liquidity, and track the financial progress over time. On this slide, for the slide number 7, I would love to share you the idea that what should be the key financial statements. The three main financial statements that I would love to introduce you are, first one, income statement or profit and loss statement. The second key financial statement is balance sheet or the statement of financial positions. And the third financial statement is the cash flow statement. For this part, for the PowerPoint set of the 10.1, I will share you the idea on an income statement or the profit and loss statement. Here you are. What is an income statement? Firstly, I would like to introduce you know an income statement. We also here call the income statement as the profit and loss or P&L statement. An income statement here provide the stakeholder, including you, right? You are the business owner, and the stakeholder should be the investor, creditor, or bank. The income statement provides the stakeholder about the revenue, all kind of the expense and profit or loss of the business over a specific period of time, such as month, quarter, or year. Again, on the slide number 10, I would like you to have the idea what are the purposes of income statements. The first one, the main purpose of an income statement is to show the business performance, that your business gain profit or get loss from your investment in this business. The income statement, right, show how much the revenue business earn from selling products or services. The income statement also show all kind of the expenses the business spend for. And here, the income statement will provide the information to the business owner, investor, or creditor for decisions making. In terms of the concept, right, the key concept of the financial statement on the slide number 11. The key concept of an income statement. The income statement always, right, you start from revenues. You then deduct the revenue by all kind of the expenses. The expense are the costs incurred to generate revenue. You finally get the third, right? Get the third one. You finally get the income, right? The net income that probably is profit or might be loss from running the business. On this slide, the slide number 12, that is the main components of an income statement that are here. The first one, revenue. The revenue is the amount of money the business take in during a reporting period. Second, cost of goods sold. We can apply COGS, stand for cost of goods sold. The cost of goods sold include the cost of the raw material and labor, that is the direct cost, right? The directly used to create the goods and service. Then the number 3 is the gross profit. That is the total revenue deduct or less by cost of goods sold. You then get the gross profit. You can use the gross profit to compute or calculate the gross profit margins. Then we go to the number 4, that is the operating expense. What are the operating expense? Here, the operating expense is the expense that incur in order to operate your business. That include, for example, rent, equipment, inventory cost, marketing cost, payroll, insurance. Then for the number 5, that is the operating income or EBITDA, right? EBITDA stands for earning before interest, tax, depreciations, and amortizations, right? How to calculate the operating income or EBITDA? As the number 5, right? You apply, right? You use the gross profit deduct by operating expense. You then get the operating income or EBITDA. Then move to the item number 6, non-operating expense. What are the non-operating expense here? The non-operating expense are costs from activity that are not directly related to a core or the day-to-day company operation, such as interest expense. And here for the number 7, that is the earning before interest and tax. Or we call another word that is the operating, right? We use the operating income deduct by non-operating expense. And here for the 8, right? 8 is the earning before tax, right? Or the taxable income. That is the income before tax. At the end, right? At the end of the slide, that is the net income. The net income is the gross income minus expense minus interest and tax. The net income reflects the actual profit or loss of the business. I will go deep down on each item of the income statement. First one, that is the revenue. What is revenue? On the slide number 13, right? Revenue, also known as sales. Revenue is the amount of money the company or the business has earned by selling the products and service over a period of time. The revenue amount includes only money made from core activity of the business. For example, if a company produced a t-shirt, the revenue would solely include earning from selling the t-shirt. It will not include money earned from selling a building or any financial investment. This, I mean the revenue, this item record in the income statement. We move to the next component of the income statement, that is the cost of goods sold. What is the cost of goods sold here? The cost of goods sold, we can call the cost of sale or cost of service as well. The cost of goods sold as the item 2, that is the total direct cost associated with producing product or service. The cost of goods sold. The cost of goods sold is the total cost, right, associated with producing the products as I mentioned. The amount of the cost of goods sold include, for example, raw material. When you buy some raw material, you need to pay the expense, right? The cost. We categorize the money that you pay for the raw material as the cost of goods sold. That is the direct cost in order to produce your products. For example, right, the same example that the business produced the t-shirt. The cost of goods sold here include the cost of fabrics and any other material used to produce the t-shirt, including labor cost. Gross profit. What is the gross profit? Okay, here on the slide number 15, the gross profit is the difference between revenue and the cost of goods sold or the cost of sales or the service. As the equation here on the slide number 15, gross profit equal revenue minus cost of goods sold. Here for the gross profit margin, as I mentioned, that you can apply the gross profit in order to compute or in order to calculate the gross profit margins. The higher gross profit margin indicates greater operational efficiency and stronger core profitability. However, on the opposite side, the lower gross profit margin suggests the company is spending too much on direct costs relative to sales. Here on the equations at the bottom of the slide number 16, I provide you how to calculate the gross profit margins. You apply the gross profit, right, divided by revenue, multiplied by 100. You then get the gross profit margins. Operating expense. This is the component, right? The component of an income statement, that is the operating expense. What is operating expense, right? Operating expense, also called selling, general and administrative expense, or SG&A. Operating expense are the indirect costs of running the business. This operating expense include, for example, rent and utility, marketing and advertising, insurance, office supply, maintenance and repairs cost, employee benefit, accounting and legal fees, or the property tax. Then we go to the EBITDA, right? EBITDA. What is EBITDA? Actually, EBITDA is the operating income or earning before interest, tax, depreciation, and amortizations. Then we can use EBITDA stand for income before interest, tax, depreciations, and amortizations. EBITDA measures operating profit of the business. EBITDA shows the company earning from the core business activity by excluding non-cash expenses, interest expense, and tax. The non-cash expense are, for example, I will provide you for example of the non-cash expense are, for example, depreciation and amortizations. This metric, I mean the EBITDA, is used by investor and to evaluate operational performance and compare the profitability between different companies in the same industry. In terms of the depreciation is the one item in the income statement as well. What is depreciation? Depreciation on behalf of as the accounting method that spread the cost of fixed assets. What are the fixed assets, for example? As the second bullet point, for example, fixed asset that is the machinery, equipment, vehicle, or computer. We normally do the depreciation, the fixed asset over its useful life. For example, might be 5 years of the useful life, 10 years, or 20 years. Method of the depreciation. I would love to introduce you the basic method of depreciation, that is the straight line depreciation method. The straight line depreciation method which I introduced you is the simplest and most commonly used method. How we can calculate the annual depreciation expense of the fixed asset. You need to apply cost. The cost is the price that you buy or purchase the fixed assets. You use cost minus salvage value divided by estimated useful life. The estimated useful life, as I mentioned in the previous slide, that is might be 5 years, 10 years, or 20 years. Here for the salvage value in the previous slide, the slide number 20, I mentioned the salvage value. What is the salvage value? Here, the salvage value is the residual value of the fixed asset. You need to estimate the value or the worth of the fixed asset at the end of the useful life. It means that if you estimate that this equipment, for example, the coffee machine, the useful life, for example, should be 5 years. Then at the end of the year 5, the salvage value of the coffee machine probably equal 0. Here, you estimate the worth or the value of the coffee machine at the end of year 5 at 0. Right? The salvage value represents the amount the fixed asset can be sold for. A salvage value can be 0, right? As I give you the example of the salvage value of the coffee machine. Shall we move to here? Earning before interest and tax. We can call the EBIT, stand for earning before interest and tax. We also call the earning before interest and tax as the operating income or the operating profit. What it is? What is the operating income? The operating income measures the profitability of a business before deduct interest and tax expenses. Here, the operating income will assess the operational performance and the profitability before financing and the tax expense. We move to here, EBT, right? EBT stands for earning before tax. We can call EBT as the taxable income. Please pay attention to the taxable income. The taxable income or the EBT measure the profitability of the business before income tax. I mentioned that the taxable income is the profitability of the business before income tax. Then you need to use the taxable income in order to compute or calculate the tax payable. Here, I share you the in case of the corporate tax in Thailand. Yeah, the corporate income tax, CIT, is the tax on the income or profit of the company. In this case, the taxpayer is the small business startup like you, right? You are the small business startup entrepreneur. In the case that at the end of the period or at the end of each year, the taxable income of your business, right? If you gain, right, the taxable income greater than 300,000 baht to not existing than 3 million baht, your taxable income need to be taxed at 15% as the corporate tax in Thailand. If your business, right, if at the end of the year, if your business, right, you gain pretty much, if the taxable income of your business at the end of the year over than 3 million Thai baht, this taxable income will be taxed at 20% as the corporate tax in Thailand. Here we go to the net income or the profit or loss. The other word of the net income we call as the bottom line. The net income, right, or the bottom line is the total earning before subtracting all expenses. That is the retained money you probably use this money to reinvest in your business. You probably use this money to pay the debt, right, or the liabilities, or you are as the business owner, right? You probably use this money to pay your business owner or the partner as the dividend payment. Here you are on the slide number 26. I provide you, right? I give you the example of an income statement of the ABC Corporation income statement. The December of the 31st. We start from revenue, right? The revenue 1.8 million Thai baht. You deduct the revenue by the cost of goods sold. You then get the gross profit. I apply you, how to get the gross profit in the bracket 1 minus 2. It means that you apply or you use the low one, that is the revenue 1.8 million Thai baht, deduct by the low number 2, that is the cost of goods sold. You then get the profits at 1.44 million Thai baht. And here from the low number 4, salary and wage. Number 5, rent. Number 6, utility. Number 7, that is the marketing expenses. From the low number 8 to from the low number 4 to number 8, that is the operating expense. You sum up the row number 4, 5, 6, 7, right? Then you will get the operating expense, that is the 735,000 baht. Then you deduct, right, the operating expense with the other operating expense. Then you add up the operating expense with the other operating expense. You will get the total operating expense, that is 550,000 baht. Then you apply, right, how to calculate the EBITDA, that is the operating income. You apply the low number 3, that is the gross profit, right? Minus by the low number 10, that is that you apply 1.44 million Thai baht minus by 750,000 baht, then you will get the operating income or the EBITDA at the 690,000 baht. The depreciation in this case, right? The depreciations, for example, I divided the fixed asset divided by the straight line method for 5 years. The depreciation should be 100,000 baht each year for the next 5 years. Then you apply, right? You use the row number 11, that is the operating income or EBITDA. Deduct by depreciation, you will get the EBIT, that is the earning before interest and tax. In order to calculate the taxable income of the row 15, you apply the EBIT from the row 13 minus interest expense. You then get the taxable income. To calculate tax payable, to calculate the tax expense. Then to compute the net income or the net profit, you apply the law number 15, the taxable income minus by tax expense. You will get the net profit, that is the bottom line of this income statement of the corporate ABC Corporation. The net profit of this company, that is the 433,500 baht. Well, that's all I would like to share you, to introduce you to have the idea about the concept, right, and the component of the income statement.